Welcome to today's episode of our Dollars and Sense Podcast. If you're listening to the Dollars and Sense Podcast for the first time, it's a show where we get people to discuss some of the most interesting finance topics. And for today's episode, we are filming at a different location than usual. We're here at the Suntec Convention Center for MoveFest 2024. And for today's episode, we'll be discussing beyond stocks and bonds, how a multi-asset class portfolio can look like in the 21st century. And joining me in today's discussion is Jermyn Wong, Head of Intermediary, Southeast Asia at State Street Global Advisor. Jermyn, welcome to the show, and it's good to see you again.
Oh, absolutely, it's good to see you.
So, Jermyn, thanks for joining us, and really today we want to talk about investing, right? And I just recollect when I was a fresh grad trying to make my first investment, I always heard of this thing called a stock-bond allocation back then, right? It suggests that you can have about 60% of your allocation in stocks, 40% in your allocation in bonds. And back then, I was thinking to myself, sounds pretty straightforward. In fact, a little bit too easy, right? There are other variations of this. So some people have this thing called the stock allocation rules, where they suggest that, you got 100% of your equities in your portfolio minus your age. So for example, if you are 30, you should have 100 minus 30, so you should have 70% of your portfolio in stocks, and then obviously 30% of your portfolio in bonds or fixed income. And as you grow older, the weightage change, lesser stocks, more bonds. But my question to you is, can a multi-asset class portfolio really be so simply designed? Because to me, it really feels too simplistic.
By the term multi-asset, the possibilities are endless, right? You can invest in so many different types of products and asset classes to form what today we term as a multi-asset portfolio. But really, if you think about it, at its core, it doesn't have to be that complicated. 60-40 or 100 minus age in terms of allocation for a stock bond portfolio can be a very good way to start investing, especially for new investors.
All right.
You're not sure what to do.
All right, so just to be clear, stock bond asset allocation, pretty good as a good way to start when you are a new investor. It's an easy way to think about asset allocation in a very simple terms.
Yes.
Right, whether it's 60-40 or 100 minus your age for equities.
Yes.
Right. So the next question is that the markets today are quite globally diversified. It's a global market, right? And even if I were to subscribe to the stock bond asset allocation concept, it's unlikely that, if I invest, say, 60% of my money in stocks, but into a single stock, and 40% of my money into, say, a single bond, surely that's not really a very good way. It doesn't sound to me like a good asset allocation strategy.
Yeah, I completely agree with you. I think you would have heard this phrase a lot, that diversification is the only free lunch in the world.
Right.
And really, it probably is. It's free to diversify, and you should definitely diversify. Investing, putting all your eggs in one basket is never a good idea. So, in constructing a multi-asset portfolio and you're looking at the stock component, make sure that it is diversified. If you ask me, my opinion is that not only should it be diversified to more than one stock, but rather it should really be globally diversified. More than one country, more than one region, more than one sector, right? And how can you achieve that? You either look at various indices or ETFs to buy, or you just have a very, very huge portfolio of different stocks that you are looking at.
Right, so essentially, I think the point is that asset allocation and diversification is not the same thing. You want to have asset allocation, 60-40 stock bonds, that could be your preferred method. But even within, say, the 60% of stocks, it needs to be diversified. And I think I agree with you, globally diversified, because the world is no longer just about Singapore or even the US, if I could say. I know that a lot of people like to start investing through ETFs, right? And how does funds like ETFs or unit trusts actually help investors, especially when I'm new to the investment space?
Well, I think ETFs are a very transparent, low-cost investment vehicle. And the term ETF itself really just means exchange-traded fund. But whether or not an ETF is good or not good, whether or not it will generate returns and how risky it is, really depends on the underlying asset class.
Within the ETF, right?
We have got thousands of ETFs today globally, and all tracking different indices with different underlying asset classes. You've got the S&P 500, you've got STI, you've got the Dow Jones, you've got MSCI World, really all kinds. Japan, Hang Seng, Nikkei. You name it, there's probably an ETF tracking an index like this. So because of that nature, it is very good and easy to use ETFs as building blocks for a globally diversified multi-asset portfolio. So say for example, if within my 60% of equities, I choose to invest 30% or 40% of that into the US, but yet I'm not sure which stock to buy in the US. Should I be looking at Meta or Amazon? I'm not sure, right? Maybe I can just look to buy an S&P 500 ETF for my US exposure. And that's what we mean by using ETFs as building blocks for a globally diversified portfolio.
I think one of the things that you said, which I kind of want to stress upon, is that not all ETFs are treated equal, right? Because I talk to a lot of investors, sometimes new investors, and then the presumption is that, oh, ETF is good, let me just invest in ETF. But you're right? ETF, it depends on what the underlying is. Are you investing in, say, the Japanese market? Is it a US market? Is it a EV market that you're investing into, right? So what you invest in terms of the ETF you choose is also important. What ETF does is that it then gives you diversified, broad exposure to the sector or to that geographical region that you look at. Can I say the same thing for bonds as well? Let's say I want that allocation in my bonds. Do I also look at ETFs?
Yes, absolutely. For bond ETFs today, there are sufficient products such that you can invest in much granularity, right? Whether or not it's US treasuries or investment grade corporate bonds or high yield bonds, US, other currencies, even Asian local currencies, there will more often than not, you will find that there is an ETF that will give you the exposure that you want, right? So again, just like equities, even within bonds, if you're investing 40% of your overall portfolio, that should also be diversified. Please don't go and buy one bond. Maybe unless it's a Singapore government bond, we can consider that. But
even then, there is no need to, right?
Exactly.
I think even if you believe that bond is so safe, why do you need to just put everything into that single bond?
Exactly.
That's my thoughts.
If that bond is so safe, then it wouldn't give you a very good coupon or yield either for your fixed income component of the portfolio. So also still be diversified. And how can you do it? ETFs would be a good avenue.
Perfect. And I just want to ask, beyond stocks and bonds, what other asset classes should investors consider as well when looking to build a multi-asset portfolio? Because one of the things I also always hear people think about is gold, right? Because and I also sometimes ask myself, gold doesn't actually give you a return. So is gold something we should consider, or what other asset classes can we consider?
The possibilities are quite endless, right? But outside of stock and bonds, I would say some of the most common asset classes to add into that portfolio would be gold, REITs, and today private debt and private equity is something which has been gaining popularity. In my opinion, definitely. In fact, we have done a lot of study and a lot of research on including gold in a 60-40 portfolio. And our conclusion is that in almost all kinds of portfolios, regardless of whether it's 60-40, 80-20, or 40-60, having gold in the portfolio would improve your portfolio's risk-return characteristics in almost all circumstances.
So it means getting higher return for the same level of risk is better when you add gold into the portfolio.
Correct. The amount of gold that we recommend to include in the portfolio is generally 2 to 5%, depending on how risky the portfolio is. So the higher proportion of equities in the portfolio, then the higher proportion of gold you should include in order to optimize your risk return characteristics.
And can I say one logic? I mean, I'm not obviously privy to this research, I'm not the researcher, but is the idea being that when the equity markets don't do well, people run to gold. There's money going into gold, hence gold prices will increase to kind of increase the resilience of the portfolio. The other thing I say is 2 to 5%, I thought you were going to say a bigger number, but you don't need that much.
You don't need that much.
Right.
We encourage investors to use gold as a portfolio diversification tool. So to your point, yes, when equity markets are down, usually gold prices would
That's
go
the
up.
theory.
Of course, it depends. There are a lot of drivers of gold. what is happening in the market at a point in time. So for example, if you're talking about today, right, one of the key drivers of gold prices, gold is almost at its historical high. One of the key drivers of gold prices is actually central bank demand. And central bank demand tends to arise from geopolitical risk or geopolitical tensions. So because of that, gold prices would tend to go up, even though equity markets have also been going up.
It's seen as a safe haven that people can still put their money into if they are unsure about central bank.
And to your point on the low allocation, certain portfolios will recommend up to 10%.
Okay.
But for most portfolios, I would say around 2 to 5%.
Right. Okay. Good stuff. And I'm sure our risk appetite as an investor also plays a part in terms of the portfolio we're going to construct, not just our age, right? So even if we are the same age, some people may be able to take a lot more risk than us. How do you think investors can go around thinking about that and about their risk tolerance level?
Age plays a very important part. What's important also is probably what your investment objectives are, right? So if as an investor, if you feel that, I don't need 5-10% type of returns, I'm only looking for 2 to 3% type of returns, but I want my money to be safe and I want very, very little risk, then you could look at a portfolio perhaps with a lot higher allocation to bonds rather than stocks. But if you're a younger investor, perhaps with a very, very long runway of investment, right? Historical data has shown us that over the longer term, equities do tend to perform better. So you could consider having more allocation to equities, bearing in mind that there could be years where the volatility and the drawdown of your portfolio will be higher, right? Which means that you could be loss-making. But if you continue to invest and continue to hold for the longer term, the data has shown that you will eventually reap the benefits. So it's really about your investment objective that should determine your risk appetite. Do you need the money soon? Do you have plans to buy a house? Do you have plans to buy a car? And if the answer to these questions are no, I don't really need the money except for extremely rainy day, then perhaps you can consider for a longer term portfolio which is higher and have a higher risk appetite.
Yeah, because markets, as the charts will show, tends to go in cycles.
Yes.
So I think some people say one recession every 6 to 7 years on average.
Yes.
And I think what we are saying is that if you don't have that time, that duration to hold more than through at least 1 or 2 market cycles, then you might want to take a less risky approach towards your portfolio.
Correct.
But if your timeline is say 20, 30 years, then you can afford to be a little bit you take a little bit more risk in your portfolio for higher return, but you have to see the market ups and downs, and that's where asset allocation is also important. Also, just want to ask you a question on rebalancing, right? Because especially when there's a market recession, right? Stocks prices down 20-30% sometimes within a month. How often do investors need to think about asset allocation? Is it once a year or whenever there is a drastic movement in the market?
Well, I think there are many ways to do this. Usually, I would recommend you can do a rebalancing or relook at your asset allocation once to twice a year.
I just find it very difficult because I remember in 2020, so the S&P 500 went down about 30%, if I remember, in a period of about 1 month. So that's 30% down in the stock market if you are exposed to the S&P 500. Even if you are looking at Singapore, it also went down a fair bit as well. And I just find it personally like, would a retail investor really, hey, the market is down, let me see what I need to do. Should I sell a bit of my bonds, buy more of this stock or this ETF that just went down 30%? I know in theory the answer is yes, but psychologically or in actuality, do you see that happening from your personal experience? Because I personally don't. So that's my point.
Well, I can imagine how many investors would not, right? And that is perhaps the reality of things. I would encourage investors to look at it a little bit more and monitor their own portfolios a little more carefully. But one potential suggestion that I have is that we can really look at investing the way that you invest using what we call dollar cost averaging.
DCA, dollar cost averaging.
Right? Or, in Singapore, regular savings
Yeah,
plans
that's what
are
some of them
available.
call in as well.
So
how does it work?
basically what you do is you invest a fixed dollar amount every month or every quarter into a particular fund or ETF. So what this allows you to achieve is to get a rather average price over the long term, because if the prices are high, you'll be buying at a higher price and getting less shares. Or if the prices are low, you'll be buying at a lower price and getting more shares for the same dollar amount every month. And if you were to do that, imagine if you had $100 or $1,000 a month and you invest $600 in equities and $400 in bonds to achieve your 60-40 portfolio. Then you do that consistently, even if there were market movements, but because of the additional new injection of funds into your overall portfolio, it should still even out, or it will make it more even eventually
over time, right?
Correct. Yeah.
Okay, so it's not, so because one thought I have is that if somebody is 60-40 into stocks bonds, and let's say stocks goes down, so now maybe they're on 50-50, I was thinking that someone may say to himself, hey, now that it's 50-50, I need to bring it back to 60-40.
Yeah.
So should I change my next month 1,000 all into stocks?
Or potentially that is also one way, but that requires a lot of effort and a lot of monitoring. Then you might as well say, in my current portfolio, I sell a bit of bonds and buy a bit of equities to make it back to 60-40.
But if you just continue with that same approach, 60-40, because you are buying more units of the ETF when prices are low, you will accumulate more, and eventually what you're saying is over time, obviously,
over a longer period of time, right, it should at least be more even.
Right. And if you are in for the long haul, then that's fine, right? As long as you have the discipline to continue investing even when the markets are down. And thank you so much, Jermyn, for sharing your thoughts with us on this topic, beyond stocks and bonds, how a multi-asset class portfolio can look like in the 21st century. If you just watch or listen to this, we really hope our discussion today can help you become a better investor. And if you like our content, remember to follow us on YouTube, Facebook, or Spotify, wherever you're watching or listening to this.